so you are aware.
Thank you, Tarika.
Hmm.
I was into IMU and ask you were doing that.
No problem.
Just so you know, Princess, I don't think I think she has another external meeting she has to attend.
Okay, thanks for letting me
Okay,
know.
no
Okay,
problem.
all right.
I'm sorry,
So here we.
I'm here.
Oh, hi,
Uh,
Princess. Okay,
Hi.
no problem. Thank you.
Okay, okay, thanks, Princess. I must. Okay, thank you. So it
Sorry.
was this meeting. This was this meeting you were IMing about.
Yeah, I was in the wrong meeting chat. I'm sorry.
No problem.
I know. Okay,
Well, I'm
now it
glad
makes
there
sense.
are. Thank you. There's lots of DCA folks on the call. But despite that, I'm going to ask that we please refrain from asking any questions until the end, if time permits. Like I said, we're trying to condense what we took in at DCA in several days down to 1 hour. So I'm going to just be going through exactly the changes from before to now. Okay. So here we
Tarika,
are. Yes, ma'am.
Tarika, if they want to put questions inside the chat, what we can do between Princess and I, sorry, Princess, I can write the questions down, and that way we can either respond to them via email blast. I mean, via blast, via the blast, the website. That way,
Okay.
it'll allow you to go through, and if they have specific questions, at least we'll know what to work from there.
Perfect. Thank you so much, Lisa.
Okay.
So yes, if you please would just leave your questions in the chat as Lisa described. All right, so this is the HOTMA compliance, the Housing Opportunity Through Modernization Act, or HOTMA compliance training, which will actually be a review of the changes to HOTMA that the U.S. Department of Housing and Urban Development, HUD, issued through a final rule on February 14th, 2023. This review was compiled using sources from the National Center for Housing Management. I used resources from HUD Exchange, HUD memos, and HUD notices, as well as the Sanford Journal of Public Policy. And if I could just ask also, could everyone check to make sure that they are on mute, please? Okay. And if there's several of you in a room, make sure everyone in your space is on mute, please. Thank you. All right, so we're going to be going through, here's the outline of the review. We'll take a quick look back at the background of HOTMA. We will then spend the majority of the hour on the changes. At the end, we'll briefly discuss what you can anticipate from HUD and DCA in preparation of the January 1st, 2024 implementation date. And due to the vast amount of information that we need to cover, like Lisa just said, would we ask that you please put all of your questions in the chat if you're comfortable to do so. And if you're not comfortable to do so, you can email your questions to compliance@dca.ga.gov. But I do want to preference that by saying that this is a safe space. HOTMA is new to all of us. There are no wrong questions. So please feel free to go ahead and drop them in the chat if you feel comfortable to do so. So without further ado, let's just jump right in to the background. So HOTMA, if you are not aware, was signed into law on July 29th, 2016. Almost immediately, HUD acknowledged some streamlining changes and further action that was needed. A proposed rule was published on September 17th, 2019, just 6 months or so before we locked down for COVID-19. So as you could understand, there has been a stalemate, which leads us to HUD's issuance of the final rule on February 14th, 2023. With this final rule, almost all provisions will take effect on January 1st, 2024. Again, let's talk about what's changing. So HUD finalized HOTMA rulemaking in 2023 and put sections 102, sections 103, and sections 104 into effect through revisions to HUD's regulations found in 24 of the Code of Federal Regulations, Part 5, and 24 CFR, Part 891. Therefore, Section 102 addresses income reviews for public housing, housing choice voucher programs, and Section 8 project-based rental assistance program, PBRA. To include the frequency of income reviews and it revises the definitions of income and assets. Section 103 is not applicable to multifamily housing programs, so that's at least one thing we can take off our plate. And Section 104 sets asset limits for both Section 8 project-based rental assistance and Section 2028 PBRA, I'm sorry, Section 2028 programs. Historically, Section 2028 programs are historically developed programs for housings for the elderly and persons with disabilities. All right, what else is changing? Here is the list of the following programs that will be affected by the final rule. So note here that the asterisk following the low income housing tax credit program indicates that the LIHTC program is affected by the HOTMA final rule to the extent that you are using the same calculations for Section 8 PBRA that you use for LIHTC. Okay, so therefore, please keep in mind throughout the presentation, if you hear of a change that affects and applies to Section 8, that only applies to LIHTC if Section 8 calculations guide your LIHTC calculations, if that makes sense. In addition, I've seen different lists of programs affected. So there's some more exhaustive lists than this. I've seen some less comprehensive lists than this. Therefore, I'm going to just say now to do your due diligence and review the final rule to ensure that you are applying the changes all across your applicable programs to make sure that your programs, whichever programs that you're using, are not affected or are affected. Okay, so we're going to jump right into income. It goes right in. So one major source of income calculation confusion before the final rule was the definition of annual income. Under the previous definition, annual income means or meant, well, currently still means all amounts, monetary or not. The definition was vague. It left a lot for interpretation. So HUD clarified the definition of annual income, not by necessarily expanding on the current definition, but it's parsed it out. So as a result, it has extrapolated non-recurring income to stand on its own. So non-recurring income will mean amounts that are not going to be repeated during the coming year being 12 months following the certification. HUD clarifies the exact sources of income to be included and excluded, as well as defines which individuals this applies to. So firstly, we have under non-recurring income, day laborers. Day laborers are individuals hired and paid one day at a time without a contract or agreement for future work. So income earned by day laborers, such as, for example, handy persons or persons typically performing what they consider hand-on jobs or physical jobs, now must be included. Next, we have independent contractors, someone whose earnings are subject to self-employment tax. Income earned by independent contractors like gig workers included. I know this is an earning category the industry has been challenged by in the past, but now it is mandatory. So this must be included, must be calculated. And then lastly, under non-recurring income, we have seasonal workers. These are individuals hired for short term to meet seasonal demands like harvesters, holiday retail workers. This is income earned by earned by seasonal workers also must be included. So here's all your non-recurring income circumstances. All right, so like I said, it parses out income into different definitions. So we're going to look at income caps next. The income caps, so neither the rules nor the concept surrounding who is a full-time student, dependent have changed. So there's no change here. The rules regarding capping adoption assistance payments have not changed. No change there in the definition. But there are some special scenarios. So before, earned income of a full-time student dependent is capped at $480 per year. Earned income of a full-time student now, remember now I'm speaking of before speaking of pre-HOTMA final rule, post, now being post-HOTMA final rule. So now earned income of full-time student dependents is still capped at $480 per year, but the amount is subject to annual adjustments per the CPIW. So therefore, the only new element that is the cap for both earned income of full-time students and income from adoption. So the income from adoption assistance payments are also capped at $480 still, like they were before. And this adoption assistance payments is also now subject to annual adjustments per the CPIW. So the only adjustments here is the consumer price index for urban wage earners and clerical workers, that's the CPIW. And just so you have an idea, now it's subject to these annual adjustments. So just so you have an idea, the all items index increased by 3.7% over the past 12 months from September 2022 to September 2023, with shelter being the largest contributor to the increase. So there's no surprise there. So you'll see that the annual adjustment will have an impact from year to year. All right, so we'll get into the income exclusions. Let me see. As a reminder here, the anticipated income is subject to exclusions and deductions the family will receive during the next 12 months that is used to determine the family's rent. So it's gross income minus your income exclusions equals your annual income. That's how you calculate the income. So sites are no longer required to determine the monetary value of items distributed to a household by someone living outside of that household. And we'll get into all of this in more detail. Housing, this is just an overview. Housing gap payments are excluded. Civil rights settlements and civil settlements are excluded. Workers' compensation does not count any longer as income and it is excluded. Payments from state Medicaid managed care systems are excluded regardless of the disability type. Payments from insurance are now excluded. There is no special rule for Section 8 regarding student financial assistance payments. Excess amounts of financial assistance will only be counted as income if that assistance comes from certain sources. And we'll look at that in more detail in a moment. There's not an exclusion. This is not an exclusion. And in the training, there wasn't a real neat place to put this, but over-income procedures whereby over-income families must have their incomes examined annually. So it's not just every 3 years now. So if a household is over-income, their income now must be examined annually, as before it was triannually. And then finally, a good rule of thumb here is unless there is income that is specifically excluded, included, okay? And then we'll go into all of this in detail. So the first thing we talked about was the non-monetary or in-kind. The in-kind is also synonymous with non-monetary contributions or income. And I said it before, but I just want to repeat it because I'm going to go into before and now from here on out. So when I'm making a comparison to before and now, again, before refers to pre-HOTMA, previous regulation, and now refers to the final rule HOTMA regulation. So before, non-monetary meant an amount, monetary or not. It was just an amount of money, monetary or not. So cash or not or non-cash. But now sites are no longer required to determine the monetary value of items distributed to a household by someone living outside that household. So examples of this are furnishings, clothing, or even a contribution from a partner living outside of the home in lieu of child support. This is no longer required to be determined, there's no longer a requirement to determine the cash value or the monetary value of those items. Okay, so before, this is income exclusions for foster children and foster adults. Before, we only excluded earned income of foster children. All other income for foster children and foster adults is counted. Now, all income received by fosters is excluded. So foster care payments, included or excluded? Somebody say it out loud. Excluded. Yeah, all income, guys, all income received by fosters, children and adults excluded. Foster care payments excluded. Foster child wages, included or excluded?
Excluded.
Excluded. Foster child's gift income, included or excluded?
Excluded.
All of it. Yeah, all of it is excluded. Nothing gets included anymore from foster children or foster adults for income. Great. Okay, so moving along, housing gap payments in terms of income exclusions. Before, there was no specific regulation in terms of housing gap payments. And just for clarification, housing gap payments are payments that happen when someone has been displaced from their unit as a result of either a natural disaster or there's rehabilitation happening to the building or their unit. And so they're temporarily displaced. Now, housing gap payments excluded. Excuse me. So an example of that is, like I said, a family being displaced due to natural disaster. The site has issued a payment for their temporary location. That payment before was counted as income. It is no longer counted as income. Any payment for housing gap or relocation, displacement is no longer included as income. Excluded. Housing gap payments excluded. Okay, before, this is income exclusion still, guys. So we're looking at settlements now. So civil settlements from an action that caused someone before, civil settlements from an action that caused someone to become displaced, only excluded if received as a lump sum. Now, civil settlements are always excluded. So an example of this is it was discovered that a child has developmental delays due to toxic waste managed by the city. The city was ordered to pay $500 a month, and they will be paying $500 a month, seemingly income, but under HOTMA final rule, excluded. That payment is no longer included. Well, it wouldn't have been before unless it was a lump sum, but even under HOTMA final rule, you would not include that $500 a month as income. For civil rights settlements, only excluded before, you only would exclude civil rights settlements, again, if it was received as a lump sum. And now all civil rights settlements and back pay, that's important, are always excluded. And another example here is a resident was wrongfully terminated in an act of retaliation by their employer. They won civil damages and back pay for withheld wages. Neither would be counted as income. And I just want a little caveat here is be familiar with your civil rights violations. So for such civil rights violations would occur for such things like workplace harassment, police misconduct, racial violence, and housing discrimination. Okay, income exclusions, we're still looking at settlements. So, no, excuse me, we're looking at workers, we're looking at state Medicaid managed care systems. Excuse me, this is not settlements. This should be state Medicaid managed care systems. So before, payments from state Medicaid managed care systems were only excluded if they assist individuals with developmental disabilities. So it was very specific. Prior regulation was very specific about the type of disability. It was only for developmental disabilities. Payments could only be included for developmental disabilities. Now, payments from state Medicaid managed care systems are totally excluded for any disability. So the example here is a head of household is vision impaired. Their white mobility canes are reimbursed by the state's Visibility Outreach Program. That reimbursement payment cannot be included as income, no longer considered income. And then lastly, workers' compensation before was counted as income, and under the final rule, workers' compensation does not count as income anymore. It is excluded. Okay. I think this is the last. Yes, this is the last for income exclusions. So we're looking at student financial assistance. Before, student financial assistance excluded, excluded according to the special rule for Section 8, PBRA. Now, after July 1st, so little note here, because the final rule goes into effect January 1st. So this doesn't take effect until after July 1st. So make a note of that. After July 1st, 2024, income from student financial assistance and any excess is always excluded. If any resident of any program receives any form of student financial aid covered in 479B of the Higher Education Act and the Bureau of Indian Education. All of it and its excess excluded. And excess here is the amount left over after the student will have paid for tuition, books, supplies, room and board. Excess amounts from grants. And you'll have to see the list of grants that are included in the final rule. There were too many to include, so excess amounts from grants, non-federal work study, and money from friends and family will be counted as income, will be included. So in my personal opinion, after looking at this and looking at this so much over the past few weeks, I think this actually needs clarification, just my personal opinion from HUD, and there may be some coming down the pipeline, but for now, you'll just have to follow it as it states. All right, so that was income exclusions. We're doing good. And we're going to move into asset calculations. Going to slow it down a little bit for asset calculations, a little bit more cumbersome, if you will. So asset calculations, for a quick review, overview first. So the new asset calculations are set up to discourage people from accessing subsidized programs if their currently held assets gives them access to other housing options. The way I think about that is, if you have access to assets that would allow you to live in market rate housing, the new final rule, it is set up in a way that will discourage you from trying to access subsidized housing and would like you to use your assets to otherwise find other housing options. The new final rule also attempts to remove barriers to the certification process. So assets that are burdensome to verify and calculate will no longer create a barrier to the certification process. And for asset calculations here, be sure that you are determining which program you are referring to, as the program determines the rules here. And throughout, as you see, there's certain policies for certain programs. So just be mindful of that. The HUD Passport savings rate is now subject to annual inflationary adjustments. You will hear that ad nauseum throughout the presentation, because that's the new final rule. It's all according to the annual inflationary adjustments. And I just read this morning, actually, on HUDuser.com that the first inflationary rate will not be published until August 2024. So you have some time to wrap your mind around that. Okay, asset calculations, the overview continued. There will be changes to imputed asset income that is more reflective of our reality. That is the reason why they're using that adjusted inflationary rate, because it's more representative of the current time, the current rates, and of our current reality. So really quickly, just recall that the definition of imputed income is benefits employees receive that aren't part of their salary or wages. There is a $100,000 threshold and policy in place to acknowledge that threshold and remedy if needed. Undeterminable assets will get calculated as imputed income. There are changes to retirement accounts that are recognized by the IRS, Internal Revenue Service, and there are new and or clarified asset exclusions under this final rule. All right, so, excuse me one second. So for assets, the HUD passport savings rate. Before, the passbook savings rate is based on the national average provided by the Federal Deposit Insurance, FDIC. The current passbook savings rate to be used for all move-in, initial, annual, and interim recertification when a family has net assets over $5,000 is currently 0.06%. Now, the amount required for imputed asset income is now subject to, you guessed it, the annual inflationary adjustment based on the national savings rate established by the FDIC. Imputing income, just a reminder, imputing income means that you treat the asset as though they've generated income, even if they haven't. So for example, the imputed income for a $10,000 asset is $6. So that's $10,000 times the 0.06%, which is going to give you $6 as your imputed income. After HOTMA, the calculation will then be $10,000. If you have a $10,000 asset, you would times that by the annual inflationary adjusted rate. All right, so we're going to look at imputed asset income. Before, you would not calculate and you excluded when cash value of assets was $5,000 or less. Now, you would only include when the cumulative cash assets exceeds $50,000. Huge jump here from $5,000 to $50,000. So in HUD subsidized programs, if a household's net family assets is less, so that for the whole household now, is less than $50,000, the household can also self-certify all of their assets. So $50,000 or less, they are eligible to self-certify. You only need to include the cumulative cash assets when it exceeds the $50,000, okay, and no longer can self-certify. And then you only calculate imputed for any asset when the cash value cannot be calculated or determined, when it's indeterminable. So for example, of undeterminable assets could be property or land, and you do not calculate imputed income for assets whose income is calculable. So if you can calculate the income, remember earlier I said if you can calculate the income, calculate it. If it's not explicitly excluded, include it. So you do not calculate, and you also do not calculate the imputed income based on the total cash value. Okay. We are looking at assets over $100,000 threshold and the remedies still. So if a household has assets with a total cash value of more than $100,000, they are ineligible for assistance. This is on the threshold side. So if they have assets with a total cash value of more than $100,000, they are ineligible for assistance. This applies both at move-in and upon recertification. This only applies to Section 8 PBRA and to housing offered under any public and Indian housing PIH program. Also, Section 8 assistance, rural housing services, or Section 202 programs are not subject to this rule. The remedies here, if someone's assets exceed the threshold upon recertification, so over the $100,000, if it exceeds the threshold upon recertification, so now you're at recert, the owner agent may delay termination for up to 6 months. So you can delay terminating the lease for up to 6 months. That's a liberty or that you have as owner agent. Excuse me. The owner agent may establish exception policies that allow households to cure their asset ineligibility within a 6-month period. So right there, that is on the owner agent to establish that policy, though. One does not exist. The owner agent has or may establish one that would allow them to cure their asset within that 6-month period, but that would be on the owner agent. There are no grandfather privileges with this rule. So you had $100,000 before, they need to be reassessed because there are no grandfather privileges here. And HUD will accept self-certification. And just again, this only applies to Section 8 PBRA and to housing offered under any PIH program. I'm going to take a quick pause and ask Lisa and or Princess if there is any burning question that you feel you can address before I move on, just to give us a little break. If not,
I'm writing the question. Parika, I'm writing the questions down.
Okay.
And I will send to you the questions that people have submitted. But one of the main questions that people are asking is, will these slides be sent out? Oh,
yes. Yeah, so they'll be on the website. The goal is to put them on the website by the end of the week. So yes, they will be. Hi, Miss.
So that was my part, is that I am writing the questions down to send to you, you know, and I wanted, and Princess may have a different answer. Princess?
No, we can go ahead and move forward with the training, and all of the questions will be answered in our blast and on the website as well.
Okay. And I just want to say for both Lisa and Princess, if you have any clarifying comments, you can just jump in and please do so, okay?
Okay.
Thank you, Tarika.
Yes, you're welcome. Oops, this always jumps over here when I open this. Okay. So we got through this slide, right? I'm going to push on to asset exclusions. I think this is a hefty part. So let me see. I'll keep going. So we're talking about real property. Under HOTMA final rule, households are ineligible to receive assistance if they own real property. Real property is any property that is suitable for occupancy. Excuse me. There are many exceptions that apply here, so we'll go look at the list on the other side here for the exceptions. I swallowed air. So excuse me. If owning real property does not leave them ineligible, though, the cash value is counted as long as they have the legal authority to sell it. I don't know a lot about legal authority and all that, but I believe that means that you are probably on the deed. If you have the legal authority to sell it, that would be my guess. But again, just my guess. It didn't explicitly say that, so it just leaves it at the legal authority to sell it, whatever that means. So here are all the exceptions to owning real property. Notably, if the property does not meet disability-related needs, I just want to point out a few here. If it is uninhabitable, so it's not suitable for occupancy, or if the property cannot be accessed because the applicant is involved in a domestic violence situation where they are actively fleeing the home or the property. So these are some exceptions to the rules here. Oh. And lastly, for asset exclusions, we're looking at before all non-necessary items of personal property counted as assets. That is very subjective. So all non-necessary items before items of personal property counted as assets. Now, only non-necessary items of personal property counted as assets if the combined value exceeds $50,000. So there's no guidance on how to verify this to date, but I will just say keep a lookout for further guidance on how to determine the value of these non-necessary items. Before, the current standard is to verify all the assets. And again, this only applies to Section 8 PBRA and to housing offered under any PIH program. I will take a moment to just revisit, because since some people joined later, that whenever you hear that caveat about Section 8 PBRA, remember that if you are using Section 8 PBRA income and asset calculations for your LIHTC program, then your LIHTC program counts as well for these, whatever, the income, the asset exclusions, inclusions, and all of that. Wherever it says Section 8, if you're using Section 8 for LIHTC, then it applies to LIHTC as well. Otherwise, it does not, and it would only apply to Section 8 PBRA and PIH. So some examples here for non-necessary items now would be like collections of cars. Barbie, you collect Barbies, you have a stamp collection, any recreational items like boats or snowmobiles. If the total amount of all of your collector non-necessary items are worth in excess of $50,000, you count them all. If not, you do not count them. Assets of foster children and foster adults are excluded. And you will have to look at the full list for the new clarified or clarified exclusions. It was quite lengthy. I didn't want to put it here, but you will find that in the final rule. All right. So we're going to go over, we got through, I can't believe it. We're doing well. We got through income and we got through assets relatively quickly. So that's great. We are going to look at deductions. And so for a quick overview of deductions first. Deductions, as an overview, are defined as the anticipated income subject to exclusions and deductions the family will receive during the next 12 months. That is what's used to determine the family's rent. So you think about the calculation here, it is annual income minus deductions equals the adjusted income. So all 5 deductions for subsidized programs have been simplified. That's what the book said, so I'm guessing that the 5 programs that it was referring to from before have all now been simplified. And now there's some deduction calculations will fluctuate based on that annual inflationary adjustment, and we'll go into that. The dependent deduction will change annually, again, with the inflationary adjustment. The elderly disabled family deduction has been increased. The definition of child care has been simplified. Child care hardship now has an exception, and the medical expense deduction has been revised. And we'll look at all of that in more detail. So we have deductions firstly for the elderly disabled family. So before, disability expenses include unreimbursed, reasonable attendant care and apparatus expenses for each family member with a disability to the extent that it allowed for that family member the provision of employment, okay? So that deduction may not exceed the combined earned income of family members 18 or older who are able to work because of such attendant care. So the combined earned income, if there were 18 or older who were able to work who were able to work because of such attendant care, that deduction may not have not exceeded their combined earned income before. Now, there's no eligibility related changes to the definition, but the elderly disabled family deduction has been increased to $525. It is also subject to annual inflationary adjustments. So that $525 is baseline, and it's also now subject to that inflationary adjustment as well. See if there's anything else I want to say about this. Okay. Deductions for dependents. Before, the dependent deduction is currently $480 per dependent. Now, the dependent deduction will change annually with inflationary adjustment. So it will also change in multiples of $25 and then round it down to the nearest multiple. I thought we wouldn't have time for examples and I would have given you one here, but if you think about it and you can multiply that by, changing in multiples of 25. So of course, 500, 525, 550, 575, and then you would round that down to the nearest multiple. And of course here, the definition stays the same. Okay, we're looking at deductions, child care deduction and hardship. So before, the definition was anticipated reasonable child care cost for children under the age of 13, including foster children, that will allow a household member to work or pursue an education. That was the child care deduction definition. Now, any reasonable child care expenses necessary to enable a member of the family to be employed or to further their education. So families can appeal now to continue to utilize the child care deduction if they cannot pay rent without it. This benefit may continue in 90-day intervals, so they can keep appealing. A family can continue to appeal every 90 days until their lease is up. That's allowed. So if they can prove, and the sites must develop policy on what it means to be a hardship, and the site must develop policy on how that's quote unquote proven. But if they can prove that there is a hardship and they cannot reasonably work or attend school or further their education, if they are not continued on this with this child care deduction, they can continue to, they can appeal it every 90 days in 90-day intervals. So this is up to the sites to develop that policy. As you can see throughout, there is some flexibility here for sites, and this is one of them. Deductions for health and medical care expense. So before, the medical expense, it was called the medical expense deduction. That was it, flat out, the medical expense deduction. Now it's called the health and medical care expenses, or health and medical care expenses deduction. So now this refers to any cost incurred in the diagnosis, cure, mitigation, treatment, or prevention of disease or payments for treatments affecting any function of the body. Any function of the body. So health and medical care expenses. This includes medical insurance premiums and long-term care premiums, paid or anticipated. You have medical bills coming down the pipeline you have like long-term treatment. So it's not paid yet, but you know this bill is coming because you have a treatment coming up. This is also now included. Final rule allows sites to add or combine a household's eligible expenses prior to reaching that threshold. And the threshold here is 10%. So it's changed from 3% to 10%. So the final rule allows the sites to add and combine a household's eligible expenses prior to reaching that 10%. It's 10% of the household's income. Excuse me. Okay, so there have been some minor changes to the certification procedures. This is going to affect changes to which type of annual income projection is appropriate for a given certification. Changes when sites must perform interim recertifications, in addition to timeframes for reporting information and completing certifications. So in terms of the annual income projections, income increases. So sites now are only required to conduct an interim recertification interim recertification for an income increase when the increase is expected to affect the household by 10% or more annually. So for income increases, the owner agent may not consider any increase in earned income of a family when making estimations unless the family previously underwent an interim recertification or an IR for a reduction in income during the certification period. And the owner may also elect to not conduct an IR in the last 3 months of the certification period at all. So I interpreted this as you can consider income increases if the increase means bringing the household back to where they started. So you can consider it if there was a decrease during the certification period, then I interpreted this as you're kind of bringing them back to square one. That's why you can then consider an increase. Otherwise, you cannot consider an increase. And for income decreases, sites may decline to perform an interim recertification if the decrease amounts to less than 10% of the household's current annual income. So that is the gross income minus the income exclusions, which is equals the annual income. So if the decrease is less than 10% of that, you can skip the interim recertification. Here, sites may impose a lower threshold than the 10%, but they cannot impose a higher threshold than the 10%. This is related to income decreases. Oh my goodness, this is tongue twisting for me. After January 1st, 2024, sites may also implement retroactive decreases for previously undisclosed income decreases. So you find out that a household did not disclose that an income, you find out that there was an undisclosed income decrease, you can retroactively apply a decrease here as of after January 1st, 2024. So this is actually goes into effect right when the final rule goes into effect. I think I'm saying that right. Retroactively, yes, decrease the previously undisclosed income decrease, yes. I feel like this should say retroactively decrease for previously undisclosed income increase for some reason, but okay, that's what it said. So I'm going to go with that. It just occurred to me that makes more sense to me, but okay, we'll leave it just how it is. This is completely from the final rule, so leave it as it is. And really here, again, determining whether to execute an interim recertification is all about determining that 10% of income and then comparing it to the proposed increases and the proposed decreases. So you're really that 10%, that's what's top of mind when you're thinking of income increases and income decreases. You're considering that 10%. Friends, we've made it through the end, possibly because I went very quickly in the beginning, but I'll talk about what's next. So what is next? There will be changes to forms and reporting, including the HUD model leases, all of which are meant to reduce the burden on providers. A new HUD handbook will be released. They have not said when, but I'm going to say that that probably should be coming down the pipeline very, very soon, as this is implemented January 1st, 2024. The new 9887 will change and will only be required to be signed once per tenancy, rather than every annual recertification as it has been. And last but not least, the rules don't take effect until January 1st, 2024 for most parts of the rules. So I would just say, because even as some of DCA has been to training, things have changed even since then. So I would just say for all of you on the call to stay informed of the changes, for your, stay abreast of the changes, as there's still some time for things, some wiggle room for things to change and be more fleshed out, or there's some clarifications might come down the pipeline. So be on the lookout for that. And then in terms of DCA, for our DCA rollout and implementation, the rollout and implementation will be sent through our customary channels. So that is our compliance blast. Be sure that you are registered for the compliance blast. Lots of details, information, updates will be communicated that way. Just as a reminder, the blast that used to come out twice a month, bi-monthly, will now only be published and distributed once a month on the 15th. So you can be looking out for that on the 15th of every month. We'll be having additional trainings. I am sure we'll figure that out as this unfolds. And then, as you guys asked earlier, or someone asked earlier, these slides will be available on the DCA website, but I will also include additional resources. And I found we have some things that are available that I'm sure will be helpful to you, videos and other memos from HUD and notifications as well. So we'll try to get those posted somewhere, either in the blast or on the website as well. And what else? I'll just take a moment, since I have the time, to make a plug for the emphasis training on the 27th.
Tarika,
yes,
not
ma'am.
to cut you off.
Sure.
I responded in the wrong
oh, no problem. You have
chat,
questions?
but the compliance manual will be published January 24th. There will be notifications coming out in the blast and on the website. Someone just asked, is there a link to sign up for
the blast?
Yeah, and yes, there is. I think someone might have just dropped it in there. Dylan, I think, might have dropped it. Thank you, Dylan.
Thank you, Dylan.
All right. I just wanted, I'm still monitoring the questions and writing them down. And there was a question that came from someone there privately, and I was trying to it will be published January 2024.
Excellent. Thank you so much for that, Lisa. And then I will, like I said, we have a few minutes, so I want to just take a moment, since questions will be responded to in the blast or what have you, or on the website. I want to take a moment to just introduce Princess. She's in compliance, and not to put you on the spot or answer any questions, but just so they can put a face to the name would be great. And Lisa, and anybody else that wants to show their lovely face on the team. Princess, you want to just introduce yourself? We have a moment.
Hi, I'm Princess Cato. Some of you may know me. I see some familiar names that has joined us today. I'm looking forward to explore HOTMA with you all come January. Please reach out to me via email if you have any questions or concerns regarding inspections. That is my forte, so I should be in contact or have some type of contact with each and every one of you that's on this call sooner than you think. It's princess.cato@dca.ga.gov. And I enjoyed every last one of the questions that you probed today. So thank you.
And Princess, your title again, please.
I am the compliance manager, in-house inspections and regulatory submissions in the Office of Portfolio Management.
Thank you. Do we have any other compliance folks team members, I should say, on the call that you can show your face to put a quick face to the name, please?
I see Dylan out there. I'm not for sure who else. I don't know if Jillian's on or not, but I do see Dylan out there.
Dylan.
Not to put you on the spot.
I'm going to spotlight you, Dylan, in a moment.
You're fine. Hi, everyone. I am Dylan Simmons. I'm the project specialist on DCA's special projects team. And hopefully we're working with partners currently. Maybe we will have connections, contacts, or possibly not. And I'm also joined by Steve and Amy on my team.
Thank you.
Yes, hello.
Yep.
My name is Steve Lukovic. I'm with the Special Projects team. I'm the Special Projects lead. And just as Dylan may have said, you know, we're here to help projects that may be struggling somewhat in several areas of compliance. And we are working with management companies on a case-by-case basis when we see issues that need special attention.
Thanks, Stephen. Any other compliance folks that we could just put a quick face to the name? Tori?
Hey everybody. My name is Tori Sadler. I'm a program assistant in the compliance department. I work under Princess. You guys probably, some of you guys may have seen my name on emails before. But yeah.
Sure of that.
And Tarika, I am not compliance. I am Lisa Dickerson,
Yes,
the
please.
policy and development
Policy.
manager
you
of
would-
policy and
yes.
development. So I work very closely with the compliance team and with Tarika, and we will be updating the compliance manual as well as the policies, anything to do with emphasis and any other policies, and working very closely to get the input from the compliance. And Tarika will present it.
Yes.
And we
other-
also do the blasts.
Yes. Any other policy and development, policy and development team members on here? Okay. And there's many others. Any last final, let me just pull up my last slide. Just close us out. Just a thank you for everyone to be here. That was the very quick, abridged version of the HOTMA final rule changes. I have it in front of me. I don't even know how many pages, but there are at least 100 or more. So definitely get familiar with the policy, the final rule. Again, DCA state policy will follow. And if you have any questions, we have the compliance at dca.ga.gov. There's my email and cell phone number on the screen. And I just want to thank you all for joining. Thank you all for taking that information in, and I will share these slides, the whole presentation on the website. And that's all we have. And I'll give you 1 minute back of your time. Reclaim your minute. Thank you so very much.
Thank you.
Thank you, Tarika.
You're welcome. Yeah, you're welcome. Have a great rest of the day, everyone. Thank you.
Thank you.
Mhm.